Ladies and gentlemen, good day and welcome to the Cholamandalam Financial Holdings Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Mistry. Thank you, and over to you, sir.
Thank you, Bhumika, and good afternoon, everyone. On behalf of JM Financial, I welcome all the participants on the call and thank the management of Cholamandalam Financial Holdings Limited for giving us the opportunity to host this call. For today's call, we have with us Mr. Sridharan Rangarajan, Non-Executive Director, Cholamandalam Financial Holding, Mr. N. Ganesh, Manager and CFO, Cholamandalam Financial Holding, Mr. V. Suryanarayanan, Managing Director, Cholamandalam MS General Insurance, and Mr. Venu Gopalan, CFO, Cholamandalam MS General Insurance. I now hand over the call to the management for the opening remarks, post which we can open the floor for Q&A. Thank you, and over to you, sir.
Good evening. This is Suryanarayanan from Chola MS General Insurance. Good evening to each one of you for joining the earnings call. I'll now proceed with the overview of the performance of Chola MS for the quarter and half year ended September 25. To begin with, on the top line, in line with the 1/n method of accounting and reporting of GDPI with respect to long-term non-motor business, Chola MS recorded a gross direct premium of 1,835 crores for quarter 2 and 3,647 crores for half year. With the base effect of 1/n reporting coming to an end in September 25, the growth in business will be visible from Q3 onwards. Chola MS suffered a loss of crop insurance business consequent to the retender, which impacted the quarter's GDPI by about 323 crores and 383 crores for the half year. The premium received in advance on long-term non-motor products was 100 crores for the quarter and 202 crores for the half year. This, together with the reinsurance inward business, the gross written premium for the quarter was 2,221 crores and 4,217 crores for the half year. In motor, the principal line of business, the market share stood at about 5.3%. Within motor, the company had a composition of 52% in cars, 37% in commercial vehicles, and 12% in two-wheelers. The company secured about 23% of its total motor premium from new vehicles. The expense of management for Chola MS for the half year stood at 30.5%, which measured without 1/n works out to 29.1% and is lower than the glide path plan approved by the board and presented to the regulator. The UIM for the corresponding half year of the previous year was 32.7, so we have seen a 2.2% reduction from the corresponding period. The claims ratio for Q2 and H1 at 81.9 and 81.5 are higher than the levels in the corresponding periods of the previous year. The motor OD claims ratio has been higher and also reflects the competitive intensity in the industry. Chola MS continues to be prudent and conservative in its provisioning for motor third-party losses, with the level of provisioning a good 10% higher than many of its peers. Recognizing the rising severity in court awards in third-party claims and the continued absence of increase in motor third-party premium for the last 4 years, Chola MS, as mentioned in the earlier call as well, stepped up its motor third-party reserving in the year. This has rendered the overall company claims ratio higher than the corresponding period by 2.31% for Q2 and over 3% for the half year. Consequently, the combined ratio for the half year was at 115.3, which without the 1/n effect stands reduced to about 112.1%. This 112.1% includes the 3% arising from the motor third-party provisioning. The investment corpus as at the half year was over 18,380 crores, and the company had mark-to-market gains in both the debt and equity portfolios amounting to about 500 crores. The PBT for the half year was 266 crores, with the return on equity not annualized at 6.2%. Solvency at 2.112 times is comfortable. We will now be happy to take any questions that you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Ravi Purohit from Securities Investment Management Private Limited. Please go ahead.
Yeah, hi. Thanks for taking my question. Sir, if you could give us some sense of how the market has been lately. I think because of the GST cut, there has been a significant uptick in the auto sector. So how does that kind of translate, or from our point of view, given that the first half has been pretty tepid for us in terms of growth of the overall premium? Of course, you mentioned that because we lost some agri business, but in the second half, how does that look at the ground level?
Yeah, thanks, Ravi. Let me take it in two parts. The first half indeed was tepid, arising from two reasons. One was the crop loss that I talked about, and second was the 1/n effect of 200 crores not getting reported the way it used to be in previous periods. That at least will now come to a level comparison as we get into quarter 3 and in October. The crop, we have digested a good portion of the portion that we had written last year. So there will be some more, about at best another 150 crores, which got reported in H2, which will not be there in H2 of this year. So therefore, the drop from here on is not going to be that steep. Yeah. Second is the effect of GST. Definitely, as we have seen, automobile sales has been quite strong in the month of October, and we did put out our numbers. The industry numbers are out there. The private sector in the month of October had a degrowth of 1.5% overall, all private sector players together. Chola MS had a growth of 5.4% in the month of October, which means that our Y2D year-to-date degrowth that we had reported at the half year is now getting reduced as at the YTD October. So it is, things are looking up, and we only wait to see if the momentum in the auto sales sustains in the months of November, December. Of course, Q4, January to March, definitely there will be a strong push. So we only wait to see if the sales sustain. I'm sure we will have a good business growth.
Sir, I think we started doing our calls on a quarterly basis a few years back, right? Earlier we used to do maybe once in a year, and then we started moving to quarterly calls. And at that point of time, I think we had kind of, mentioned about getting our combined ratio, closer to, let's say, 105% or so. It's been persistently higher. If you could kind of share some insights into, how should we see our combined ratio over the next 1 or 2 years, and things that are in our control, right? It has been a competitive market, but there are companies whose combined ratios are lower than ours. Is there anything that you could kind of share on the steps that we are taking to kind of, bring this down?
Yeah, so we will not talk about the competition's combined ratio or what is shaping it. So I think that's outside the ambit and scope of this particular call. We would rather stick to what we are trying to do and what is shaping our combined ratio at this point in time. In my opening remarks, I did talk about the motor third-party reserving that we are adopting at this point in time. And I did mention in the call that our reserving level, that what we are doing, is at least 10% higher than many of our peers. And in our book, that translates into an effect of at least 3% on the COR. If without 1 by N, if I am talking of 112, so that means that the correct, on a comparative basis, this comes down to about 109. Now, going to your question on it was 109 in previous years, it is at 109, and what is going to improve? The question is the way we have been conservative in our commission recognitions. For instance, when 1 by N came in, our sessions reduced and therefore our reinsurance commission also got deferred. Now, actually, as we go along and when this 1 by N premium starts coming into the P&L segment, our reinsurance commissions will also start going up and we should see a bounce back into the overall profitability. But one area of concern, I should admit, has been the way the motor OD loss ratios have been moving up, both for the industry and particularly for Chola MS. We are seized of the problem and have taken several corrective measures. One of the measures which will certainly, of course, this is also arising from the GST change. Chola MS has got a larger proportion of motor business from commercial vehicles. I did mention that we have about 37%. Now the GST change that is coming in terms of the GST on parts prices coming down from 12% to 5% will also give us some advantage as we go along, as the severity of the claims will now go down. So that will be a small positive which will come in, which will also help. And of course, the other corrective measures that we have put in place and which should bring the loss ratios to a lower level.
So just one observation, in our presentation, we give this breakup of investment book, right? And historically, we had moved a significant portion of our investment book into AAA rated and government security bonds, right? Lately, in the last 2 quarters, I've seen PSU/corporate bonds going up significantly and government securities coming off. So just wanted to kind of, get your, thought. I'm assuming these are still all AAA rated. But if you could just kind of share, is there a change in how we are kind of allocating our investment book?
Yeah, our investment book earlier used to be very heavily loaded towards the government securities, as you rightly talked about. But we have strengthened our investment management team and other thing, research work and other thing. You know very well that the interest rate yield for government securities and corporate bonds are, comparatively, higher. We moved into a level of more towards the corporate bond in order to increase the yield on the investment book. That's the thing. But what we are doing very clearly is, not to reduce our rating profile on those corporate bonds. We are only looking at those profiles which are high in terms of the rating and the profile point of view. So we are not diluting anything on the security on those investment book. That's the philosophy on which we moved. And altogether we are slightly above 40% even now. The threshold is 30% government securities. We are at 40% around.
Okay. And last question, sir. I think in the last few calls also I had asked you, generally, what is our long-term goal from return equity point of view, and I think FY25 we did cross 18%, and prior year was about 15-odd%, right? This year looks like it is below the first half at least. But would you kind of still stick to what you had mentioned earlier, that we should remain in the 16 to 18% ROE band in the near future?
Yeah, that is the direction with which the management team is certainly working for, and we certainly expect to get closer to those levels.
Okay. Thank you and all the best, and I'll get back in the queue.
Bye. Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Sanket Godha from Avendus Spark. Please go ahead.
Thank you for the opportunity, sir. This 570 odd crores of reinsurance accepted business, what you did in first half, can you just give the color of the business? Is it predominantly sitting in crop, given we lost it on direct, we started doing it on reinsurance, or it's more towards commercial lines? Just wanted to understand the color of that business. And how profitability of that segment has played out in 1H, given we did little more than usually what we do in the past.
Yeah, it is. The volume is a little higher than what we used to do in the past, and it is actually the volume is spread across lines of businesses. We do have in property, we do have some in crop, we do have some in motor, and we do also have a good portion arising from the group health business. So it is across multiple lines of business. And it suffice to say that the economic combined ratio of this business is better than the combined ratio on the core business. So it only operates to bring down the overall combined ratio.
Okay, understood, sir. But sir, means if the float in that business is little lower, and even if the combined is closer to 100, then from an ROE point of view, it might be still depleting compared to the leverage benefit what we get from the direct business, especially from TP. If I can ask on ROE basis, still it is ROE accretive, or we have it's ROE dilutive in a way?
So I would broadly tend to think that it is ROE neutral. So so it is not going to impact that, because the overall that's how it will tend to operate. I would tend to think that the problems and the difficulties at this point in time is more in the motor line of business than anywhere else. Of course, you have attended other companies' calls as well, and you know the kind of combined ratio levels that are getting operated in the industry. And the problem is further accentuated because of our own stance and prudence with respect to the TP reserving. While that does not, it is reserving, it does not impact cash flow. But then the effect is still there when it comes to the combined ratio and naturally the ROE.
But will you continue this reinsurance strategy going ahead too, or it's more tactical for the current year, or if I can ask whether EOM played a role for you to go a little aggressive on reinsurance acceptance?
See, yeah, it is like it's an overall package, Sanket, and I know this is a question that you have been asking of other companies as well in different ways, and people have proceeded to answer it in their own fashion. So it is a tactical move, and also from considering also the fact that we did lose the crop business, so did others. So one which is where that has come about. But the thing that we are seeing it positive is, apart from the effect that it helps us on the UIM, we have also used this opportunity to really cut down on our UIM even in our core business, and which is what should help the company going forward.
Understood, sir. Understood. And the second thing I wanted to check with you is, sir, that given that we were very strong players in benefit long-term health and PA, given these numbers are declined for last 3-4 consecutive quarters, is it even if I do this math on N basis, have we seen still a decline, or the decline is predominantly because of the yen? Basically, the thing what I wanted to understand is that if the reporting would have been on yen, the health and PA segment would have grown or declined for us.
There will still be a marginal decline, but we have hung on to our, say, economically viable businesses And still our benefit mix, if you are to look at on the overall health business, would still be at around close to around 40%. It has come off the level of 46-47% that used to be in earlier years. It's come to 40 now, but it is still there.
Okay. And given now, I'm assuming EOM is under control. Whether this piece will do again asking on yen basis a little better going ahead, or it is a conscious decision because commercials are not working in your favor, so that's why you chose to slow it down.
Yes, because see, there is this is the last year of the glide path, and one had to move down to conform. So that is also a tactical call in that respect. But as I started off in the on full premium basis, you would notice that our cost is now EOM is at about 29 point something. So which also is, even from a glide path perspective, there is some leeway for us to take business, good profitable business, and which is what we will proceed to do in H2.
Understood, sir. So another question was on motor OD, which you touched upon, that loss ratios are a little elevated because of the competitive intensity. So now given GST cut has happened, your IDVs will come down, claims will remain where they are. So is it fair to say that ceteris paribus, that the loss ratios will deteriorate? Maybe new product mix might improve the loss ratios, but in general, directionally, maybe you will benefit from the float or investment book, but on combined or loss ratios, these numbers will look little more poorer than what you are reporting for you or for the industry because of the IDV cut.
See, the IDV change arising out of GST is more prevalent in the new business. The older vehicles, the changes in IDV hasn't really happened as yet. And I'm speaking this position even as at, say, closer to mid-November. That is how it is getting played out in the industry. And I did mention that our total share of new business is somewhere around 24-25. So the 75% of the business is not undergoing a change on the IDV at this point in time.
Okay.
That is the situation. So that is the situation. Yeah.
Understood, sir. And sir, this 83% loss ratio in OD, means honestly, this is a little uncomfortable number from your perspective also. So if you give any concrete measures, what you have taken exactly this number to improve going ahead, and what likelihood this number will improve to, despite the competition challenges?
See, our point is that in H2, if you were to look at, we would certainly want this number to at least come down by about 5 percentage points per H2.
And measures to achieve
that will coming in from the other changes that we have made. So that is a prediction that we are trying to make for H2, going by the effect of the changes that we have now put in place. And that is what we expect.
Understood, sir. But in general, I'm saying that you were always like 71-72% loss ratio company. Even if I negate the impact of what you call additional reserving what you have done for TP, now you still look like more 78-79 combined loss ratio company. Maybe you got a benefit of expense, but is it fair to say it's a trade-off that the expense comes off at the expense of loss, and therefore you end up at the same combined. So just wanted to understand, that's the way I need to understand, because expense ratio improvement got reflected in higher loss ratio. So that's the reason I'm asking it. Or both can move independently so that overall combined can improve.
So they can move independently, and see, this is a stance that we have taken with respect to motor third-party provisioning. Of course, all efficiencies towards securing the actuals at much lower levels is on by way of a higher proportion of compromise settlements, where I should say that the company is doing well even at the half-year stage. So again, we will take a closer look at how things shape up, and maybe in December and again in March. So we could look at a more pragmatic situation there.
Lastly, on leverage, again, maybe I'm just asking this, maybe it could be repetitive for you. Typically, we always enjoyed the higher leverage 6 plus 6.1, 6.2 kind of a leverage. Now it has fallen, still very healthy compared to the industry standard, but has fallen. So again, is it fair to say that your defocus on long-term plans has led to lower leverage, but we did not get so much of advantage in the combined. So net that leverage benefit, what was there in the ROE, did not play out at the expense of EOM management. Is it a fair way to think, sir?
No, in a way it is true, because somewhere in the mentioned in the presentation deck that there is a very conscious move with respect to the two-wheeler business that's a view that the board has taken. When you do new two-wheelers on a 1+5 basis, so there is a cash accretion that happens. But then the worry is in the context of absence in pricing. Is it really worth taking on a risk for 4 and 5 years from now? And what is absolutely certain is the inflation running at whatever level in terms of the compensation level. So it is a necessary trade-off between whether you want to have an accretion and have investment book and earnings now, and then liability really getting deferred into the subsequent years. So that's the call that the board really took, and that's what is driving. It is on page 55. If you look at it, we will say growth in OD premium and degrowth in TP premium, and primarily conscious reduction of volumes in two-wheelers. So if you look at it even in the motor book, while we have a OD market share of 6.3, we have actually brought down from 5.4 to 4.7 in motor TP. So that is what is impacting the leverage. And this I would tend to think is more tactical because it's not that we have lost any channel or anything. So it's more a question of what we and how we choose to source. Of course, there is always talks of an impending TP price increase. We never know when it's going to happen. The sooner it happens, it's better. And then things can certainly pivot back.
Understood. Likelihood means maybe that's my last question actually. The likelihood of TP price hike. Will we see the light in the current year, or you are hopeful at least the next start of the next fiscal we'll see a price hike?
I would tend to think that industry will be very happy even if it comes in from April 1. But then the necessity, the preliminary steps will have to be taken now to make it effective from April.
Understood, sir. Yeah, thank you very much for answering my question. That's it from my side.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah, thanks to everyone for joining the conference call. The management is committed to taking the company forward, both in terms of growth and profitability. Thank you.
On behalf of JM Financial, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.